All right, it's your show, Zach.
Excellent. Well, hi everyone. I am Zach. Been trading for about 6 years. Been following Avi for quite a while as well. Really excited to be part of this group. Guys, I was in call on Friday and you guys were playing poker, taking money from each other. So I was like, this is the place to be. The presentation today, it's going to be about footprints. I've been trading using footprints for quite some time now, a couple of years. Like I said, I've been trading for 6 years, about 3 or 4 of them exclusively futures. The reason I went with futures is I like the tools and I like the centralized data that comes with futures. So we'll talk about one of the tools I utilize in my trading, which is footprints, how I use them, how to read them. This is very beginner friendly. I want it to be more of an interactive session. So at the end, there will be a Q&A. If you guys have questions in between, just pop in with your mic, interrupt me. If you want me to articulate anything further, feel free to interrupt me, but we'll take it away from here. So I gave it a fun little title, Footprints 101, a look inside the matrix, because that's really what it is. We're looking inside of the internal data of markets and seeing what's going on behind the scenes. All right, so we have a roadmap, what I'm going to talk about. I'll put these slides in the Discord so you guys can go through them later, reference them if you want. The first thing we're going to be talking about is the different types of liquidity in the market. So, you know, there's quite a few styles of liquidity. The two that you need to concern yourself with as a day trader are passive participants and aggressive participants. So we'll simplify it. Passive participants, these are people you see on the DOM, the depth of market, or the level 2. These are people, I want you to think like someone who's stubborn, they're selling something and they're like, I'm not going to sell this car unless I get $15,000 for it. Not a penny more, not a penny less, right? That's my limit order. And then there's aggressive participants. I like to think of these as like scalpers, people that are aggressive. Price is moving and they're like, get me into the market as soon as you can. Right now, I want to be in it. These two work hand in hand. For the most part, you need a aggressive participant, someone you'll see on the time and sales and stuff, to fulfill the orders of passive participants. Not always, but for the most part. And then, yeah, a standardized tape is what you'll use to see aggressive participants. All right, so this here is a footprint chart. I'm going to assume most people are not too familiar with this, so I'll go really into the basics. There's multiple styles of footprint charts out there, and the style you use should be based on what type of information you're trying to extract. So if you look right here, I have a standard candlestick chart. Oops. I have a standard candlestick chart. And then right here, I have the exact same chart, but it's in a bid and ask footprint. And then I have the exact same candlestick, but it's in a delta footprint. Now, these two are telling you the exact same information, but through a different lens. Essentially, what a footprint is designed to tell you is what the market order data looks like. So if we go back and we look at a time and sales, it's showing you what the time and sales would show you, except in a refined format. You don't see limit orders. You don't see passive participants until they're fulfilled on a footprint. So when you're looking at a footprint like this one, this is a bid and ask footprint. So essentially, the left side is market orders hitting the bid. The right side is market orders hitting the ask or the offer. It's pretty interchangeable, those two terms. So every time a transaction is being fulfilled, there's the last price that it's being traded at, last. And then there's the subsequent bid, and there's the subsequent ask, right? Now, when you're reading a footprint, a bid-ask footprint especially, it's actually designed to be read diagonally. So the corresponding ask to this 75 bid is the 19. It's actually not the 66. That's how it's traditionally meant to be read. However, in the markets we trade, they're super liquid. You know, a tick on the NQ is nothing. So people don't really concern themselves too much with the diagonal spread. They'll just read it horizontally. And there's no issue with reading that, reading it that way. That's actually how I read it as well. So I like to read it horizontally. So what I'm seeing when I'm looking at a bid and ask footprint right here, for example, is there's two contracts being traded on the bid via market orders, 19 orders being traded on the offer or the ask on market orders. What this is designed to tell you is the imbalance. So you're seeing that there's an imbalance of, well, -2 plus 19, that's 17. There's an imbalance of 17 buyers here at this specific price point, whatever it is, right? In this example, there is a difference of 20 and 30. So if it's on the bid side, it's always a minus because it's a net sell. It's a market sell. So it's -20 plus 30. So +10. That's your imbalance. You could also have an imbalance of a negative imbalance like you would here, or whatever the math is there, or like 130, something like that, or 160. You could have an imbalance, right? The goal of this is to help you see where the outlier data is inside of a candle. Like this candle isn't giving you all the information you need. This one is giving you a lot more information on what the makeup of this specific candle is and how much you can trust it. You can start viewing the data in specific areas of candles and getting internal information of it. So yeah, this is a standardized bid-ask footprint. I do not use this footprint. What I use is a simplified version of the same information. I use a delta footprint. Delta is just the difference between a bid and an ask. So what this is doing is, instead of us having to calculate the difference between 20 and 30 in our heads, it's 10. What this is doing is it's just calculating the difference for you. So whatever the makeup of this is, equal to a net imbalance of -952 sellers, right? Same thing, -1,000 sellers, +44 buyers. There's your imbalance. It's just the delta. Same information, just cleaned up for you. That's the one I use. So that is pretty basic way of reading footprints. Now I'll show you what my specific footprint that I've designed looks like. So we have a reference point for what I'm using. My footprint is a delta footprint, and I've just added a study to it that also shows me the net volume. So just like the prior delta footprint, you can see market orders here, you can see buying market orders here, here, here. You can see selling market orders here, same thing. However, on the far right side, this blue profile here, it just shows you the net volume. It doesn't distinguish between buyers and sellers, just shows you net volume. I'll talk about why this is important in a little bit and how it can add some more contextual information for your trading. But yeah, that's a quick overview of how to read a footprint and how my footprints look like. So next, I want to talk about the type of order flows that you're going to see in the market. There's a few, and if you start trading super higher time frame, there's a couple more concepts, but as a day trader, and to be real, like all the styles of trading that we do, the only two that matter and the only two you need to concern yourself with are these two. There's continuation and there's absorption. Continuation is simple. It's in the name, right? It's when the market is structured, it's trending in one direction, it's flowing seamlessly. That's what continuation is. So the internal information of that is just when market orders, you know how we talked about how passive liquidity needs market liquidity, aggressive liquidity to get filled. It's essentially continuation is when market liquidity is overwhelming the passive liquidity. So in a scenario where it's trending up, you often hear people say the buyers are lifting the offer, sellers are hitting the bid, there's urgency, there's little resistance from the opposing side. And we'll get into this in a little bit. This is a pretty cool concept, but the auction, the market structure is in a phase where it's breaking out, it's expanding. This is where you'll usually see this continuation order flow. And then there's the second kind of order flow. This is what is really popular with order flow and footprint traders especially. This is the imbalance. This is the absorption. Absorption, it's also in the name. You want to think of, well, I'll go over this and then I'll talk about this little GIF here. Absorption is when there's a lot of passive liquidity that is getting too overwhelmed, or there's market liquidity that is getting overwhelmed by the passive liquidity. So essentially just think there's more passive buyers at a level than there are aggressive buyers. So if you guys are familiar with Bookmap, for example, let me quickly pull something up. All right, let me know if you see this. You should be able to see a screenshot of Bookmap. Assume so.
Yep, we see it. It's good.
Excellent, excellent. What Bookmap is basically showing you is passive liquidity is these like red, orangish bars, and market liquidity is these bubbles, right? Bookmap takes both of them and combines it in an interesting visual view. In my opinion, this isn't the most efficient way to view this data, but when you see a large set of passive orders, a large wall on Bookmap or on your level 2 or your DOM, you want to think passive liquidity, right? So let me close that. When I say the passive liquidity is holding firm, the passive liquidity is greater than the market liquidity, the aggressive liquidity, it just means there's a wall of orders. There's a wall of people, let's say we're breaking out, and there's a new level that we broke out from before, and now new buyers are like, hey, when it hits there, buy me some on the bid. They're sitting on the bid as passive participants. When price is shifting downwards into that, there is the market orders as you're shifting down are selling into buyers. So they're getting absorbed, essentially. Price isn't advancing. It often creates rotations and reversals. And this is where this concept of trapped buyers and sellers comes from. I'll show some examples where we'll be able to see that stuff. And then I found this little GIF. Well, I added the annotations to it, but this is kind of how I like to see it or imagine it. Passive liquidity, like what we were talking about in Bookmap, as you're breaking out, there's passive liquidity. You want to think of that as a ceiling or a floor, concrete. And then you want to imagine the market liquidity, the aggressive participants, as a jackhammer, right? And you're trying to see if the jackhammer has enough steam, has enough battery power. I'm sure they're not battery powered, but has enough power to break that concrete. And if it does, then you're going to tank. And if it doesn't, then you're going to reverse back up, right? That's kind of the job of what a footprint at an absorption phase does for you. It helps you highlight this information and get an internal view of what's going on. So continuation of absorption. Let's go through some examples. So the first example here is a trending market. Now it doesn't matter what time frame this chart is. It could be a 1 minute chart. It could be a 5 minute chart. Markets are fractal. It doesn't really matter. Same thing is occurring no matter the time scale. This specifically, I believe, is a 1 minute chart. If that helps you in any way. But for example, this is a clean view of what continuation looks like. To break it down, you're just seeing buyers continue to step in as new highs are made. So I like to imagine it as you're actually at an auction, and as price makes a new high, right? This is the candle's high zone. As it makes a new high above that, I'm looking at the liquidity. I'm looking at the market, and the market orders, and I'm seeing, are there people initiating new position aggressively in this area? Are they, as it makes a new high, are they getting even more aggressive? Is this squeezing, right? So you see, there wasn't much here, but that's fine. And then here we make new highs. Look at the squeeze. They're adding more. They're adding more. This is a great sign. As price goes higher, bulls continue, in this scenario it's bulls, they continue to just press higher. They press higher. They continue to press higher, right? And there's little to no resistance from the other side. This is a great example of expansionary price action, trending price action. And this is how you can use internal data from footprints to see whether or not your trend is being validated. All right, so here's an example of continuation, however, to the downside. Same idea, pretty much. Sellers are continuing to step in as we make new lows. So new low right there, they press. New low right there, they press. New low in this area, they're kind of pressing. New low, they press. You know, it's not always the cleanest. Like, obviously, this press is slightly higher than the new low. Markets aren't perfect, but it's a feel. That's what you're trying to get out of this. Yeah, and here, as you make new lows, they continue to press. So this is a sign like the auction is being engaged, or it's being I don't know what the perfect word would be here, but it's being continued by the sellers. They're just willing to pay lower and lower and lower. They're not hesitating. They're not saying inside. They're not saying, "Oh, this is too low to keep selling this thing. Let's wait for it to get higher again before we sell it." No, they're initiating new position continuously. So yeah, volume is building lower and lower. And again, this is very important. Price is in an expansionary phase. I'll talk about this in a little bit, why it's important. Okay, so here we have examples of absorption. Again, absorption is when passive liquidity is overwhelming the aggressive liquidity. You want to think of it like this. As buyers here, they're stepping up. Well, there's a lack of buyers actually here. There's a little bit here, but it's just as much selling. Excuse me, that is a clue. We won't talk about that right now, but that could be used as a clue. Was that, as you're seeing, price makes a new high, you see a bunch of buying, but that buying isn't fulfilled. Now I want you to think of it like this. If you're in a position and you buy a high of day and it doesn't start working, are you going to be like, yeah, you know, I'm not stressing out, I'm just going to hold this thing? Or are you thinking, do I need to get out of this position? Do I need to de-risk, you know, take this loss and move on to the next trade? These large participants, they are not going to hold. They're not going to hold forever, especially in these types of contexts. So they have to buy and sell. And one thing that isn't spoken enough in markets is that for every transaction, there's two sides. When you buy something, someone has to sell it to you. When you sell something, someone has to buy it from you, right? And there's another fun saying. It's that every time you're a bull, every time you become a buyer, you have to become a seller. Because when I buy something, eventually when I sell it, I'm going to be working against my initial thesis, right? We could say, yeah, I made a bunch of money, blah, 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 but I have to eventually become a seller to get out of the market. And because these participants are so big, when they're buying, you want to think their buying is creating a move, while their selling is also going to create a move. And if they start selling in a panic, it's going to create a very large move. This is what traps are. So I want you to imagine it like this. This is an area of resistance. I'm not just going to short just because I see this. We'll discuss that in a little bit, but you need more context than just imbalance, or at least I do. But we make new highs, you can see, and we get a huge press from the buyers. This is looking good. We're making new highs, but it doesn't get follow through. They're not being rewarded. And when you're not being rewarded, you need to eventually exit your position. So you can see as they make this press here, the candle closes as a huge doji, hammer, whatever you want to call it, with a huge wick. And then the subsequent candle right after that, you can see them panicking as it presses the new lows, right? You can quite literally see they got too happy-go-lucky right there. And then they're like, oh crap, I'm too heavy. I need to start exiting these positions. And there's their liquidation breaks. This is the concept of trapped buyers. Again, they need to exit their positions if they don't get rewarded. Their exit liquidity becomes their worst nightmare. It is what causes the price to sell down more. So really intelligent sellers will see trapped buyers, know that they have to exit, and they're going to press on top of it. So it's like you're already hurt and someone's kicking you while you're down. That's basically what's going on here. So yeah, buyers are present at highs, but there's no continuation. Passive sellers, so the passive liquidity up here is so large that it's absorbing all of this market liquidity. So limit is greater than market, and then usually price is in a rotational phase. It's at an area where it's either going to be reversing or it's at a prior resistance, something like that. So that is the first example of absorption. I have another one. This is a trade that I took. Same thing, but this is for the sell side. So trapped sellers in this scenario. Again, price is shifting down. It hits a level of support, right? And when it hits the level of support, as it tries to make new lows, see a bunch of selling, see a bunch of selling, you see a bunch of selling, you see a bunch of selling, you see a bunch of selling. That's 1, 2, 3, 4, 5. That's 5. These are 1 minute candles. It doesn't really matter, but 5 minutes worth of sellers trying to press new lows, but getting no reward whatsoever. Eventually, they're going to have to exit their position. And if you're dialed in enough, you're going to actually be able to see them exit their position. I call this a delta flip. So the net delta here was sellers controlling the delta. And then right here, you can see the buyers flipped to controlling the delta. And that's where your turn happens. That's where they're quite literally just beginning to get squeezed out in these areas. So yeah, a level of support, then you see aggressive participants not getting rewarded. It's a good sign of absorption. You wait for the right entry signals, and then you get in. Here's another example of absorption. Again, a support level. So I'm not blind buying it just because it's struggling. I'm layering my context. Trap sellers. So they press new lows. It's looking good. It's looking good. They press new lows. They don't get fulfilled. And then the next candle has a decent amount of buying here. And institutional money does not initiate new position. let me rephrase that. Institutional capital does not flow into the market using new longs through market. Like big money doesn't buy on the market. They buy on the bid. They are the passive participant. It's you and I and panic sellers, panic buyers that are getting out on the market. So who's the panic buyer in this scenario? Well, everyone who's shorting down here and here and here, and they're like, oh shit, the price is about to turn. They're going to panic and market out. They can't afford to be patient with their positions. So because of that, because they can't afford to be patient with their positions, because they can't afford to be patient with their positions, sorry, my screen just lagged. They have to exit on market, and you're going to see them exiting. So this is a great example. Again, huge selling, it's not getting fulfilled, and then you see the flow of the market turning. It's at a support level, and then I got in as that huge imbalance printed of positive 230. That was my signal to press into this trade, and then you take it long, and however you want to ride it and manage the position, that's up to you. You have to build more context. This is just an additional tool to use on top of your already defined system. So that is absorption. Okay, so the do's and don'ts of footprints. This is more about what footprints are and what they are not. This is quite subjective. This is my view through the lens that I trade. I know of traders who exclusively use footprints. And listen, if you can find edge in that, good for you. How I approach it is this. So these are my do's and don'ts. The do's, you should trade with market structure. Now, I'm a futures trader, and in futures, I'm sure many of you have already heard the concept of auction theory, auction market theory. This is basically just the theory that when you're in a range, you will balance out. You're just gonna, chop around, and then when you break out of the range, you're gonna take all of this compression and spurt it out and expand away, or you fail to expand, which is a failed expansion, failed breakout, whatever you want to call it. And when that happens, you rotate to the other side. These concepts are extremely present in markets. There's they happen every single day on every single fractal scale. What I like to do personally is I will incorporate this concept in with the footprints. So I get fractal with it. What I do is, let's imagine this is a 30-minute chart. I will define my range or my balance, whatever you want to call it, on a higher time frame. And then when it hits that level, I know what the possible outcome of that will be. Then I get fractal. I zoom into like a 1-minute chart and a footprint chart, and I start looking for ways to get into that trade. So I trade with market structure and the auction, and I trade footprints at clear inflection points, or I view them at least at clear inflection points. To tie into that, I don't want you to chase every print. It's human nature to find a new tool, to find something new and think this is the holy grail, this is God's gift to me, it's not. This has to be incorporated with other things. And if you stare at a footprint chart 24/7 all day long, you're going to drive yourself crazy. There's natural levels of, I believe it's like glucose in your brain, where you have to, those get depleted as you make more decisions. Footprints kind of make everything look like an opportunity. So you want to be very careful not to drive yourself crazy staring at this stuff. What I personally do is I will wait for my levels of inflection before I look at a footprint. Like a footprint is not on my screen until I'm alerted that price is at a level I want to engage with. So don't chase every print. Don't trade in the middle of ranges. This is my style, so I'm just commenting on that. I don't like to transact in the middle of zones. I find that with footprints, because it's the middle, there's a lot of false signals, if you want to call it, that look like good trade, but it's just noise. So you don't want to engage in the middle. You want to, again, engage at clear inflections. And then, yeah, my personal belief again, don't trade footprints without an underlying strategy. This is like the cherry on top. It's not the sundae. Market structure and then order flow, not just order flow. Okay, I have some trade examples. This one is, okay, what we can do is I'll walk through my entire thinking process of the setup, and then I'll tie in the footprint so you guys can kind of see how I'm framing this. This is a trade from February 12th. So I believe it was, well, I didn't trade at all this week. So these are all from last week. February 12th was last Thursday. Okay, perfectly. So a week ago. This is a daily chart right here. This is a 1 minute chart, and this is a 1 minute footprint chart. On the daily, we have key support right here. We were going down, and then we lost our structural support. Once we lose the structural support, I'm thinking, okay, this is in a downtrend phase, and we're trying to get to the next level, which is like that area. So this is now trending in that area. Based off of that information, I start looking for specific types of trades. So because we're trending down, I want to play one of these pull back and goes, that type of trade. Just like a standard bear flag, you could call it. So yeah, we break the structural support, which was, it was actually all the way up there. So we were going like that, and then they broke it, and now they're in that phase. Once they start doing that, I have an idea of what to look for on the footprint. Once you get dialed in enough with footprints, you kind of know what your setup is supposed to look like on a footprint. So you can be preemptive with it, slightly preemptive with it. If I'm trading a bear flag, it's moving down, then it's going to pop up, and then it's going to move down. I know what the internal story is of this. So price shot down. And another interesting thing you can take a look at, just a little side note, is right here at the bottom, I have information on how much volume was traded and how much delta was traded. I don't really look at the volume, to be frank, but I do look at the delta. I just glance at it slightly. You can see as this candle prints, we have minus 1,300 almost imbalance. So 1,300 imbalance sellers. Price is shifting down. And excuse me, there's no support in this area based off of structure I've defined. There's no support. We're sinking down. And then out of nowhere, we just see some buying. And then we see some buying. And then we see some buying. Instantly, I'm like, this is either shorts covering a bit of their position, and then like dumb money, like retail money thinking, oh, this is a bottom, so let me buy this. When in reality, it's just a micro bottom, and it's gonna flush through it. So as it's shifting down, it's in a trending phase. I see a signal of trapped buyers on my pullback. Once I see that, they make a new low. That's my strategy. I usually wait for a new low. I trigger short right there. And then, yeah, you just ride the trend down to the next level, however you want to trade it. So yeah, higher time frame loss of support, lower time frame bear flag, and then trapped buyers is my order flow signal. Here is another trade. This is from Friday last week. Okay, so Thursday and Friday last week. the market is, there's basically a range. This is like a volume profile. And then we're accepting back into this range, kind of like that drawing I have. So it's going to come into the level, it's going to pull back, and then it's going to, you know, doing that. And during the pullback phase right there of acceptance back into your range, I preemptively know what it's supposed to look like. So when I start seeing those things, I can just be quick on the trigger, right? So it pulls into our range, we see decent buying, and then you just see a bunch of selling, as it's doing like a flagging structure. And then they do a little delta flip right there. That's my signal to get long, simple stop right there. And then exited as we did a delta flip. It's cut off here, but there was a slight delta flip, new low. And again, in a way, some absorption up there. So you often see a lot of my exits and my entries in terms of the order flow, they look very similar. And that's just because I'm using the order flow to discretionarily get in and out of trade. And yeah, this is how I framed this: higher time frame rotation, lower time frame bull flag, and then trapped sellers is the absorption concept. You'll notice I do not play much continuation breakout style trading. At least I don't enter into that. I like to enter into pullbacks. That's just my specific style. But if you define a strategy on getting into continuation style plays, footprints are very useful. Okay, I added an example from October 1st, 2024, so a year and a half ago almost, just to show these concepts are kind of timeless. Again, we're pushing up. This was a higher time frame area of resistance, something like that. We push up. We have this 1 minute fractal range, right? What's fun about this is, why don't you take a look at this range right here, right? And let's look at the structure of it. We have the range high, and then we have the range low. And as we breach the range high, I'm instantly thinking, if they breach this, I see a ton of buying and it's not rewarded. This is my signal to get short. So take a look at this range, what it looks like, and let's go back to this example. It's the same thing. There's your failed breakout. It's just the opposite side, of course, but it's the same concept, right? So I'm tying this into other things. There's my imbalance of buyers and sellers. I know this footprint looks a little different than the other ones I showed. It is still the same delta and volume footprint, just the color is different. But you'll see imbalance of 129 buyers, 117 buyers. They don't get fulfilled. Somewhere in there, I start triggering shorts, and then I just close the position at the next logical support zone. And this is an example from a year and a half ago. So yeah, lower time frame failed expansion / failed breakout, and then trapped buyers, again, absorption. And you can also see here, there's the delta flip. So this one right here, the second row is delta. As we're pushing up, looks good, and then we go into a resistance in this candle, and the buying kind of slows down. That's my first little indication that, hey, maybe something is changing here. And then you can see the next one they just stuff it, right? And then the next one, they stuff it even harder. So yeah, another way you can access this tool. Okay, this is an example from yesterday. I wasn't at my desk yesterday, so unfortunately I didn't get to execute on this. However, this is again the classic setup that I kind of always use. If we go back here, it's this one. It's a range. It breaks away from the range. It retests the range. And then on the retest, I look for absorption using the footprint. And I get in. So I know what it's supposed to look like on the footprint right here. So let's remember this phase. And go to the example. This is just the same thing, but it's just downside. We facilitate trade, break, retest, and then go. And then you can see this is zoomed into this area. As you see, you're pushing up. This was yesterday, so you're pushing up, you're pushing up. And as you're pushing into this pink level I have here at 907, which is that, it's a prior low, you can see the selling, the delta here at the bottom. And you can see it through these footprints as well. As you make a new high, there's very little buying. As you make a new high, they actually didn't make a new high, and then as you make a new high, there's very little buying, and then there's some traps up here at an area where we're thinking if it breaks, it comes retest, and then it goes. Now I preemptively know what it's supposed to look like, so I will start watching for that. And then candle structure, I like to use Avi's naked trading style and incorporate that all. So I see my trapped, well, I didn't take this, but I would see my trapped buyer right there. I would see that as we came into resistance, the buying pretty much dried up. And then I would see the flip in this candle. You can just see how as we make a new low, the sellers get aggressive. And look, the buying, weak buying, well, no, weak buying, decent buying, like neutral, some selling now, final weak attempt to buy, and then, right, they just press it down. And you can see that on the internal data on the footprint and on the little thing I have at the bottom, the delta flip. So those are your footprint signals at an area. So I'm layering my trades. That's what I always do. And I just labeled this higher time frame resistance, lower time frame. So higher time frame resistance, as in this zone in general, was a higher time frame zone of resistance. Lower time frame breakout and then retest. So that was this. And then the order flow, it was trapped buyers and then a delta flip. So right there. Oh, okay. Well, that's it. So yeah, those were a few examples, and then we'll do a quick Q&A if anyone has any questions. I hope I was able to articulate myself correctly or efficiently. Everyone was able to follow along.
That was great, Zach. Thank you. I found it very insightful for sure. I loved it. Yeah. Looks like we got a question here. Yeah, Nassim, go ahead. You got a question? You there? No.
Nassim, you're on mute.
You're on mute. Right. All right, go ahead. MJ, you got a question? Go ahead. Yeah, everyone's on mute, huh?
Yeah, I can't hear anything. What platform do you use for footprint charts? I personally use a platform called Sierra Charts. I would not recommend it. The reason I wouldn't recommend it is it's not user-friendly at all. The learning curve is extremely steep. Sometimes I question why I even decided to use it. There's a lot more efficient 80-20 type of programs. TradingView is great. Another good one is I'm blanking on the name here. Go Charting. Go Charting. So why don't I type it out? TradingView, Go Charting. Those are great. Another really good one that is Quant Tower. Quant Tower is great, and it is also free if you open up an AMP account. Just like a lot of people use Thinkorswim, they put some money into a Thinkorswim account and they get Bookmap. Same idea. You put money into AMP, which is a US regulated broker. I use AMP. It's a futures trading broker. If you put money in their account, they give you Quant Tower for free. It's a fantastic software. And then you pay $2 a month for data. you can use that. And then there's obviously Go Charting and TradingView.
Cool.
At what point in your journey you started using the footprint? You said you've been trading for 6 years, and you know, at what point you thought this is the right move for you to do it?
So originally I came from the stock world. Started with like low floats because I'm a degenerate, and I moved to futures because the tools are interesting and all that. I believe it was just a couple of months into trading futures. So if my timeline's correct, I started trading futures 2.5 years after I started trading. So maybe like year 3 out of 6, and I've been using it ever since.
Nice.
Got a couple other questions here. Sujit wants to know, what time frames do you use?
The time frame that I use is the 1 minute. All these examples were 1 minute. However, it's not really about the time frame. I know it's often a cop-out answer to say that. I can see the exact same information on a 5-minute chart, and sometimes even like a 15-minute, 30-minute chart. Essentially, all you're trying to do is, my style at least, is I'm waiting for a level to get engaged. And once the level is being engaged, I'm looking for the traps and I'm looking for the flip. So because you're seeing internals, the internals are kind of the exact same no matter the time frame you see. I specifically use a 1 minute, but I know a lot of people that use 5 minute. A lot of people that trade footprints, they don't even use time-based charts. They use tick, range, volume, all of these interesting charts. But me specifically, I tend to stick to 1 or 5 minute.
Cool, thanks. Nina, you got a question?
Yes, I do. First of all, thanks for the presentation, Zach. Very insightful and also a very nicely structured, I think. I would be interested in, what do you consider a decent imbalance to enter a trade? Like how many, how did you call it, the delta flip? Mm-hmm. How big does it have to be for you? And does it depend on the asset, on the specific futures contract? How do you handle that?
Yeah, okay, so great question. You kind of answered it actually for yourself. It does depend on the asset. I would not look for the same amount of delta absorption on something like a bond future as I would on ES or NQ, right? So it does depend, and it's also relative to the amount of volume being transacted on a day. Now, I don't look for a specific number. If you take a look at my daily chart here, I know it's a bit sacrilegious to be using volume candles. It's obvious when naked trading, but I often look at how much relative volume is coming in, and it just gives me an eyeball. With ES, I usually look for like 150 plus as a good sign. But the interesting thing is that my footprint and most footprints are configured to view output the data relative to what is printed. So you'll see like the 81 buyers here is almost the same size as the 168 here, because relative to the candle, it's the same amount of it holds the same amount of gravity relative to the volume traded on the candle. You see this candle had 9,000, this one had 6. So relative to that, I kind of don't specifically look at the number. I look at the shape to see how large it is. But a good eyeball, if you're trading ES, is 150-ish. Should be good. And sorry, to answer the second part of your question, the delta flip, I'm usually looking for it to be larger than the absorption candles. So if this is like absorbing at 350, I want the flip to be just as big or bigger. It's usually a good barometer for pressure. So yeah.
Great, thank you.
Yep.
Awesome. I like the way you're using it with talking about passive players and aggressive players, that's pretty much the same thing I'm looking at. The absorption, looking for reversals, looking to enter on pullbacks. Everything you went through here, it's the same reason why I've gotten into footprint charts, just to get those really neat entries. And then trade management is a different subject.
Yeah, like trade specifically right here. You can get great asymmetric risk to reward if you really dial into the right trade locations. And that's what I've always loved about your style, Avi, is how you were able to incorporate like naked trading and then see all of this stuff. And then if you just layer some order flow onto it, this is a 10-hour trade, right? And there's nothing too complicated about it. Just a pullback, and then you're waiting for the internal data to flip, a few signals, and then you take it, and then the rest is just, it's in here.
Mm-hmm. Yeah, that's brilliant. That's a good way of saying it. That's the whole point. You can get better RVR when you get better entries, and these footprint charts allow for better entries. You look for the right place on the chart, the levels, and then read the prints.
Yeah, an extra 2 points can greatly skew R to R, and footprints allow you to de-risk as well. So yeah, it's great.
Brilliant. Yes, Sumit, go ahead. You got a question?
Sure. Hey, Zach, thank you. Do you also use Bookmap for anything? If yes, then how do you use it?
I do not use Bookmap. I've had subscriptions for Bookmap. I don't find it too useful. I can just see the information on a standard DOM or level 2. And to be frank, this is like tinfoil hat Zach, conspiracy theory Zach. I don't even think it's a conspiracy theory anymore. They don't want you to see their liquidity. If you view markets long enough, I'm sure all of you have come to a similar conclusion that once you break from a significant level and then you come back to it, there's sellers there. I don't need Bookmap to tell me that there's passive sellers sitting there, right? That's just how the markets are designed, and they're not going to even show themselves to you on Bookmap or on the DOM at all times. So it kind of defeats the purpose. You can just feel the flow using a footprint. So to answer your question in a long-winded way, I don't use Bookmap.
Thank you.
Yeah, and I like that very much. And to help with that, or to add to that, we know that, well, as Zach said, they don't want you to see the liquidity, and we know on the level 2, we keep seeing the orders coming and going, icebergs, various spoofing, all kinds of stuff. So it's hard to rely on. But when it comes to footprint charts, once you see the print, you know that, okay, there was a market player hitting a limit player, and it's right there. It's become real. And then when you have something real, you can believe in it. You can trust on it, rather than someone telling me, in the future, we have some orders over there. Anyone talks to me like that, I'll throw them out. Because I don't believe in the future guarantees. Make it real, and then you can believe in it. So again, looking at various indicators, I put that part in the course as well. But this footprint thing is very much in the moment real indicators. Can rely on.
Yeah, this is not a lagging indicator by any means.
Yeah. And it's not a crystal ball either that pretends to tell you the future, which is what I found with the level 2, which I stopped using it.
Yeah. No, I have enough experience with level 2 to tell you that there's not that much edge in it.
There you go. Very good. Yeah, Vinay, go ahead.
Hey, great presentation, Zach. I have a question about the volume profile on the right side of these candles. How do you use them? And in this particular trade, can you share where did you enter?
I did not take this specific trade.
Okay.
I would have entered, hypothetically, with my trade system, I would have entered right here. Because I wait for the imbalance at the level and then a new low to be closed. That's standardized my process. So if I was at my desk, I would have taken it there, but I did not take this trade. And your initial question was, sorry, could you repeat it?
Yeah, the volume on the right side, the blue.
Yes.
How do you use them?
Okay. This is a little bit more advanced, but it's really fun. So I'd love to discuss it. Let's see if I have a better example. Okay, before we get into it, I'll share it right here. Hope this isn't bleaching everyone's eyes. Actually, let me make it a black screen. Okay, so this is a bit more nuanced, and this is how I personally use it. This is market maker theory, and I'll condense it into like a minute. Essentially, if everyone knows what a volume profile is, I'd assume so. It's just a standard distribution of volume. So looking at this, we can see where most of the volume is being traded, and we can see where less volume is being traded. Now, the market is an auction. I'm sure you guys have heard that before, but what does that really mean? Like, let's say we're at an art gallery, and we're bidding for the Mona Lisa, and someone's saying, I'll pay $1 million, someone's saying, I'll pay 2, I'll pay 3, I'll pay 4, I'll pay 5. The auctioneer, this is how I imagine it, the auctioneer is like, okay, does anyone want to pay 1? Okay, how about 2? How about 3? How about 4? How about 5? And it keeps going, it keeps going, it keeps going. And as it's going, price is moving up, price is moving up. And in a standard auction, when you hit the limit of the auction, someone's like, I'll pay $200 million for the Mona Lisa. And then the room goes quiet, no one wants to pay more for the Mona Lisa. The auction is finished. However, markets are a two-way auction. So as price is cycling up in the auction, when the auction stops to the top, it starts cycling down, right? And why this is important is if you want to think about what market makers are incentivized to do, a market maker's job is not to take price up. A market maker's job is not to take price down. A market maker's job is to facilitate trade. They want the most transactional potential. They don't make money on price going up. They don't make money on price going down. They make money on transaction fees. Every time a contract is traded, they're making a small fee. That's their incentive. It's to facilitate a market. So what a volume profile shows you is where in history, volume has been conducted the most. It's this like bulk zone has been conducted the most. So when price transitions to an area where it's light, right? You can start thinking like if volume dries here, if no one says I'm willing to pay higher, and you can see that on a volume profile, if it's not building more, excuse me, you can think of that as a finished auction, right? And then we will rotate back to value. So if you look at this, hopefully I'm not going on too much of a soapbox. This is the same concept. This is a volume profile. You could think of it like that. And the balance is right there, right? How I use the volume profile with footprints is the same concept. I'm trying to see where volume is drying up, but I'm looking at it on a micro scale. So essentially, you can look at it from this is a fine example. And because we're getting on a micro scale, I do want to preface, the larger the scale is, the more accurate the volume profile gets. These are 1 minute scales, so it's not perfect, but once you develop a feel, you'll get good at reading it. You can see as price is transitioning down, where does the bulk of the volume sit? Right here. It's here, right? And then when it goes here, the auction, it's like the room gets quiet, right? When I see that, I'm like, okay, they're unwilling to initiate price down here. You want to be careful when buying through that, right? They need to build volume in order to go down. They need to incentivize the market maker to go down. So here's them building the volume. Now I'm like, okay, I see them building the volume. I saw the other confluence of the trap. I have the idea that this is a downtrend environment. I have all those check marks. Now I use it. So that's how I'm using the volume profile. And then it helps me also stay in trades. Like you can see volume continues to build. Volume continues to build. I took some off because volume wasn't building here. And then later on in the candle, it actually ended up building. But you can see it continues to build. Show another example very quickly. in a trending environment, you can see volumes building. As we get higher, the market maker is continuously incentivized to transact price higher. Volume is building. Volume and delta are two separate things. They're tied, but they're giving you different information. So volume's continuing to build higher. This is what people, when they reference, I forget the exact term, but volume is building. I think that's just what they say. That's what they mean, and that's how I use the volume profile.
Hey, that's great. So when the volume is building, it's a sign that the price will go further down or continue?
Yes, yes. It's willingness from participants to engage at these prices.
Nice. Thank you so much.
You're welcome.
Can you hear me?
Yes.
Yeah, Nassim, you're back.
Hey, Zach, great presentation, first of all. So the question is, since you started using these charts, how much did your trading improved, like in terms of the win rate?
You know, it's hard to say exactly because I've been evolving as a trader in all facets throughout my entire career. I would say they definitely help more than they hurt, of course. I don't have a real win rate example, to be frank.
If you put it in percentages, like did it give you like a 20% bump, 30% bump?
It would be hard to say, to be frank. Like, yeah, probably like 20% maybe. Again, it's a tough question to answer. I think what it gives you more than anything is conviction in your setups.
Right.
And it gives you a way to, you know, I frankly don't, that's another soapbox. I don't entirely believe in backtesting to its chorus of depths, but what I'm trying to say is it gives you something to look for. It's another layer of, I'm looking through what happened in the market today. This is a setup based on my criteria that I would have taken without the footprint. And now let's look at the footprint. Does it give me that? And then it's an added layer of confluence. So more than just win rate, which definitely helps my win rate, it gives me more conviction. It gives me more conviction to enter into my trades and to hold them.
And another question is, whenever you see the price turning, right? So like there's if there is a reversal or something, how do you know based on these charts that it's a reversal and not a temporary pullback? Is it based on the structure?
Yeah, it is based on the structure of the setup itself. You know, I think one of the realities of trading is that a lot of times you will get into the right position and it's going to dance around your entry a little before it gives you the full move, and you just either have to hold around that or build systems to manage around it. Footprints aren't really going to tell you at the point of inflection. They're not really going to tell you too much information on how far it can go. That will be defined by the setup. Absorption kind of looks the same on a 1 minute bear flag as it does on like a 15-minute bear flag. There's no real way to know. I guess one way I kind of decipher it is the delta flip, how heavy it is. But my process is that when I get into a trade, I have a way of de-risking the position, and then I just let the runners do its thing.
Cool, thank you.
You're welcome.
To add to that, I think the one thing that win rate may give you a better win rate or not, but one thing that the reason I'm interested in footprints is that it can definitely give you a bigger RVR on your trades.
Yeah.
In that sense, you can maintain the win rate or even lower your win rate, whatever. Because RVR really, in the end, the way I like to say it is, it's your license to print money. The bigger the RVR, the better. As in your losers are small and your winners are big. And that's it. So if you can tighten up those entries, you know, off you go. And I think footprints are useful for that reason more than anything else.
Yeah, the conviction to hold the trade, you know, like you're seeing like the volume is building to the downside, and if you're short, you know, that's very impressive, very good presentation, man. That was awesome, and I like that. That you know, as long as the volume is building down, you're holding onto it, and when the volume disappear, you are cautious about your trade. That's very deep, because you in a tape you can see the orders going, but this shows the history where the orders come in and where the if they're coming at the price lower or not. That's cool.
Yeah, glad you liked it.
Yeah, good stuff, Zach. Thank you. This was great, man. This was great. Anyone got any other questions at the moment? All good? Everyone's an expert now in footprints? Know what you're doing? Love it. All right. We'll end the recording here then.
Thank you, Zach.